Good morning. Welcome to Friday's edition of Trading Hour. Considering the Trump tariff tantrum, we are going to say, thank God it's Friday. I'm Reema Tendulkar. With me is Vivek Iyer, and we're coming to you live from the CNBC-TV18 Motilal Oswal studio. And what we have on our hands at 11 o'clock is that all global markets are sinking on the back of these global jitters, Trump-induced, the Trump tariffs hurting, the sentiment across all markets. The Nifty is now just below 23,000, though just maybe in the last 30 minutes, we've seen the Nifty recover a tad bit, a couple of points intraday. That will come up for you on your screen. But benchmark indices down 1% for the week so far. The Nifty's lost closer to 2.5%, while the mid-cap index has lost nearly about a little less than that. So that's the picture when it comes to the benchmark indices. Outside of that, it's the Asian markets that we should take stock of. The Japanese index is down nearly 4%. The Korean markets are down 2%. Hong Kong and China, remember, are shut today. The mid and small caps are, bearing the bigger brunt of the selling pressure. The mid-cap index is down more than 2%. The small-cap index is down 3%. And look at the advanced decline ratio. Yesterday, we were celebrating, despite all the global volatility and chaos, the advanced decline ratio was positive. But today, it's completely reversed. 2,100 stocks in the red for about 430 stocks in the green. Big gap between the stocks advancing and declining stocks. And on the way down, it's metals. Again, the fear is global economy tipping into a recession. So metals is weak, IT is weak, and pharma. Look at the way pharma collapsed in a matter of minutes after Trump said that pharma tariffs are perhaps coming very soon.
Good morning, Reema. Absolutely. So yesterday, the entire pharma back, saw a rally on the back of the fact that there were no tariffs being implied. And there was a little bit of a cool-off towards the end of the session in most of the pharma names yesterday. But today, there are fresh bites from Trump himself indicating that there are going to be tariffs on pharma, and tariffs will be at levels never seen before. On the back of that, the entire pharma index. Look at names like Dr. Reddy, Lupin, Cipla, Sun Pharma, Laurus Labs. All of these, Aurobindo Pharma at one point of time was actually at the lower circuit, the first lower circuit of 10%. They've all recovered a little bit, but the entire generic pack today is under significant pressure. What's actually helped the recovery, especially in the last half hour, is the fact that consumption stocks have seen a recovery. So names like Colgate-Palmolive, names like Nestle, names like ITC, Britannia, these are some of the stocks that have actually aided the recovery as far as markets are concerned, and financials like Bajaj Finance and HDFC Bank too have helped prop the Nifty slightly higher after the kind of intense sell-off that we saw in just an hour ago. But the most important story of the day, Reema, has to be pharma. Remember, pharma stocks fall following US President Donald Trump's comments on tariffs for the sector. He said that pharma tariffs are under review and will come in at levels never seen before. Let's listen in to what he had to say.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future.
Okay, let's go across to Vinny now to understand the likely impact these tariffs, potential tariffs, could have and the exposure that Indian companies have to the US.
Latest update that has come in where Trump made some comments coming in on the pharmaceutical space, saying that they will be announcing tariffs in the near future and not the distant future. And because of that, we're seeing pharma stocks are in focus today. Now, let's take a recap of what is currently charged by India on US. So India charges 10% tariff on pharma imports. US currently is not charging any import duty on the products for Indian category and Indian companies. So yes, as of now, the charge is nil. Now, what Trump wants to do, wants to charge them with a reciprocal tariff on this front. So it will be 10% or more than that. That's something that we're keeping an eye out on. What is the risk and who is at risk in terms of pharma companies? The main risk comes in for generic formulation players and CMO players in the pharma space, which is at the highest risk. The exposure of US generic companies is quite high to Indian companies to US generics is quite high, and that is why we will see that impact coming in. One-time hit in terms of EBITDA that we could see coming in, a negative impact would be around 9 to 12%. This is according to what we have a note coming in from Citi. Now, obviously, let's talk about the exposure. Gland Pharma has an exposure of 50%. So the impact on its EBITDA would be in the range of 8 to 10%. Aurobindo Pharma, 48% exposure to the US, and that would be in the range of 12 to 13%, I beg your pardon, in terms of the hit on the EBITDA front. Dr. Reddy's in the 10 to 12% range, 47% exposure there. Zydus, 46% exposure, so 8 to 10%. Lupin, Cipla, Sun Pharma, and Torrent Pharma, a lesser exposure is what they have, and the impact on the EBITDA is lower. Now, why is that so? Because these companies have facilities in the US. Cipla, Dr. Reddy's, Lupin, Syngene, Piramal Pharma, Sai Life Sciences, all of these have exposure, means in terms of facilities that they have in the US, and that is why they're already set up in terms of the facility there. So maybe they could start importing from that facility. Instead of importing from India, you can sell from those facilities, which doesn't charge as much duty as what it would be charged from the Indian manufacturing facility if imported there. And that is why lesser impact on these companies on the EBITDA front as well.
Thank you very much for that. To take the discussion forward, Nimish Mehta, founder research at Delta Advisors, and Aditya Khemka, fund manager at Incred Asset Management, join in on the show. Gentlemen, thank you very much for joining in. Even yesterday we knew, right, although it got exempt, we knew that future tariffs on pharma are not entirely ruled out. And now the president has said it's coming, and in not so distant future. So Nimish, first share your thoughts, right? What could be the base scenario and what will be the impact on Indian pharma?
Thank you for having me on the show. What I understand is that, the pharma-related tariffs are not strictly going to be like the reciprocal tariff that we have seen for other sectors. It is more to do with safeguarding their essential product supplies and also to probably safeguard some of the technology that otherwise gets shifted outside of America. So this is more like, Atmanirbhar Bharat kind of a thing, and less like a reciprocal tariff, which is a reciprocal tariff, I understand, is just evening the differences between tariffs of two countries, something with, US and the other country. So in this case, the focus is likely to be product specific and essentially on products which are supposed to be essential medicines for the US market. And that's how I feel it is likely to happen. And in that case, China would be one of the biggest impact, losers in a way. And indirectly, that might also even help Indian companies. That's my first view on that.
Okay, so which products, Nimish, to your mind, would be most affected or would come under the purview of these tax? And you're saying we're not going to get a baseline tariff, even if it's, say, assume a 10%. You don't think that's the likely scenario? And then coming back to the point, product specific, which products, and why do you think China is going to be impacted more?
So first of all, China, because, most of the essential products or the APIs are being supplied by China. And that would include, even the essential products is what I believe. And that is, and we also know that there was, even before Trump came in, we already had a Biosecure Act, which was targeting China and essentially to ensure that the technology doesn't go away. So China, one, has high CDMO exposure, and two, because their APIs are dominating the market, including that of US market. And that's why that is going to be of, higher impact to them. Second, I particularly don't know which are the products which are considered as essential products for the US market. But if I may to make some guess, probably some cancer medicines and, cardiovascular medicines and stuff like that might probably be under pressure. But I really don't have that information as to which are the essential medicines considered by the US market.
Right. Aditya, let's bring you also into the conversation. Yesterday morning you joined us and you said that pharma tariffs are not yet being imposed. The relief that we enjoyed yesterday was very, very short-lived. Aditya, your first take on this, and also if you could help us, if you've done any sensitivity analysis in terms of, which are the companies you expect or which are the players that you expect to be most impacted. Will it be the generic players? Will it be the CDMO players? Or will it be the specialty pharma players?
Hi, good morning, and thanks for having me. So just to begin with, I think the most impacted players will be generic players. The reason being twofold. Number one, the volumes of generics that goes from India is significantly higher than the volume of innovator products or specialty products or API for that matter that go from India to the United States shows. So the highest impact will probably be on the generic players. Number two, because these generic players don't have any bargaining power on the table. It's a commoditized product that they sell. Every player has the same product. So when it comes to the bargaining table with the buyer or with the government as such, they don't have any bargaining power on their side to sort of discuss any meaningful outcomes for themselves. So the pecking order would be mostly impacted would be generics, followed by API, CDMO, and lastly the specialty guys, because the specialty guys have the most bargaining power. They have patented products. So those products will have, help them to get more say into the matter compared to the generic guys.
Any tariff, whatever form it may come in, has to be borne by someone, Aditya, whether it's the end consumer, whether it's the distributor or the manufacturer. Now let's talk about generics to begin with, since they might be potentially the worst affected to your mind. They already add wafer-thin margins. So what are the current margins? And now that you have to do some sort of an analysis, right? Because you're looking into the future and the future is all unknown. But what could be the potential impact? How much will they have to bear? And therefore the EPS estimates. And in that context, then how do the stocks look after the correction?
Yeah, look, so it's very, very difficult for us to quantify what margins these companies make in generics because they don't report these margins separately as such. They report a consolidated margin. What I can tell you is that if there are three potential buyers in US, wholesalers in US that buy from almost 300 plus pharma companies from India. And the products are basically commoditized. There is no differentiation from one manufacturer's product to the other. So if you just think of the bargaining power tilt here, the tilt is clearly lying with the three buyers versus the 300 plus suppliers. So in that scenario, who bears the brunt? Economics would tell us it is more likely to be the pharma companies that will, maybe not completely, but partially will have to bear the brunt. And then also so if you look at the complete supply chain, right? So there is the insurer, there is the wholesaler, and then there is the manufacturer. I think the most fragmented industry in any supply chain bears most of the brunt. And in this situation, the most fragmented industry is the supplier, which is the Indian pharma manufacturers. So if you have to sort of put me in a corner and put a gun to my head and ask who will bear the most of the brunt, the economics will tell us it has probably got to be the pharma manufacturer.
Right, and which is why we're seeing the kind of impact on the pharma stocks today. Nimesh, just throwing a couple of phrases at you. Number one, generic price erosion, something that Indian pharma companies have been seeing for quite a while. Second is, a lot of companies are talking about reshoring back to the USA. And number three, something that you mentioned, relative better placed that India is compared to China. On all of this, what is your view, especially the fact that reshoring is expected to take quite a bit of time, right?
Correct. What I understand is that the reaction that we see today on the stock market to me looks a little overdone because, yes, there is a lot of competition in the generic segment, and I fully agree. But, the primary reason of this competition or the pricing pressure we see in generic is also because of Indian pharma manufacturers. So there are so many manufacturers, which is itself is, kind of drawing the prices down in a normal market scenario. But if you look at Indian pharma as a consolidated unit, so their bargaining power is going to be very high. So in toto, if there is one company who is getting impacted because of the tariff, the most likely scenario is that all of their competitors or most of their competitors will also be in the same boat. So from that perspective, I believe that the generic prices may just go up, and in case where they just the generics exit the market, then there is also a fear of having shortages in the market. That's what we have seen, for example, in the last few years, where GMP regulations became stricter, and you see so many factories actually under trouble, and that is what was driving shortages and also eventually the prices up. So my sense is that Indian pharma per se is kind of relatively better poised, and especially when you compare it with their counterparts in China. So that way, I think, yes, purely speaking, if you put a number in the Excel sheet and say, here is the profitability coming down, well, this is what the reaction might be. But if you say that, right. So it's a non-discretionary sector where you can't just avoid consumption.
Right. Thank you so much, Nimesh, as well as Aditya, for joining us. It's still a developing story. We don't know the quantum of tariffs. We don't know when the tariffs will come. But Indian pharma stocks today are reacting quite sharply. Thank you once again for joining us. Let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Welcome back to Trading Hour. Well, as promised, we'll now shift focus to the commodity space. Manisha joins in, and today we're focusing on crude.
Well, yes, we are looking at crude oil prices and various other commodities as well, Vivek, because everything has seen a very sharp decline on the lower side. Yesterday, during the day, in all time zones, whether it was Asia and then Europe and then US markets, we've seen a decline. And that has just seen a more repeat of that happening in Asia right now. So the crude oil prices fell 6% yesterday, and we're looking at another percentage of a decline in the Asian markets on your screens right now. Well, three things here. One, of course, it is about the fears of global trade war after the kind of tariffs that we have seen come in. The world believes that this could lead to weaker oil demand going forward for 2025. The second point is the US inventories, which have surged way more than what the street was anticipating. And the third thing is about OPEC and allies, which have decided to increase output by 411 barrels per day starting the month of May. And they could increase it in the June. And this is much higher, 3 times more than what the street was actually calculating. So always you have seen the crude oil prices decline because of that. But it's not just crude. Take a look at the gold prices. 1.5% of decline overnight. And gold has continued to see a further decline. If you look at the gold range yesterday, we saw an all-time high of 3,160 on the higher side and then 3,060 by the New York Times yesterday. So it was $100 of a range, and we seem to be holding around 3,100 at this point in time. The other thing is about silver, which also saw a decline of 5.5% overnight. Not just silver, platinum declined 4% to a 2.5-month lows. Silver is trading at a 1-month lows. Copper prices have continued to decline as well, 2% of a cut coming in for that one, 3-week lows there. And then the agriculture industrial commodities like cotton for textiles and then rubber for various things also saw 4% of a cut coming in, and we are looking at multi-month lows onto that one as well. Many of these industrial commodities also have declined because you've seen a bigger chunk of tariffs coming on China, which is the major producer and consumer for many of these commodities. So a major hit coming in because of that as well.
Okay, commodities hit as Trump has threatened demand and the economy, and even gold, has slipped overnight. Sometimes you sell not what you want, but what you can to lock in the profits. Manisha, thank you very much for that. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar joins in with his top trading bets. Welcome back. We've managed to get our head above the 23,000 mark, but it's still a steep cut of 250 points. Sensex down 650 points. Mid-cap index deep in the red, 1,200 points gone on the mid-cap index. Mitesh is now back with us for a quick technical check on the markets. Mitesh?
Yeah. I think the biggest worry for me is that the Nifty is, below 23,100. And if we get a closing below that, while there is mild support at 22,950, which is where, we have made a low at 22,920. But broadly, that could, a closing below 23,100 could suggest a breakdown and possibly more declines in the coming times. And we could then be looking at a test of 22,800 and in the worst case scenario, 22,600 as well. So, let's see how it pans out till the end of the day. But this is not a very positive sign. The good thing is that the bank Nifty is comfortably placed on the upper end. And move above 51,800 could add Philip, and that could, in turn influence Nifty as well. So both the indexes watching closely, but trading with stock-specific biases.
Mitesh, your individual picks and also a view on the pharma sector is seen quite a bit of a knock. Do you feel some of these stocks can see a bit of a bounce back?
So on the stock side, I have a buy on Colgate-Palmolive with a stop at about 24.14 for targets of around 2,500. That's one stock which is braving this fall very well, and the setup has also improved dramatically today. Strong buy signals on the intraday charts as well. So that's a positive stock. The other one is a buy. The other one is a sell on Infosys with a stop at about 14.71 for targets of 14.20. As far as pharma is concerned, we had this slightly positive sentiment when the tariffs were announced, but then today there's some kind of a breakdown on most of the pharma stocks. So not very positive over there. The one which I like is Glenmark. If it can hold above 1470, 1475 zones on the closing basis, if that happens, then you might see a bounce back there.
Thank you so much, Mitesh, for joining us, giving us a view on the markets, your individual stock-specific ideas, and also your view on the pharma pack. But we'll now take a short break. Up next, we'll discuss market fundamentals with Madana Gopal and Ramu from Sundaram Alternate Assets. Welcome back to Trading Hour. Well, the brief rebound that we saw in the markets has once again ensured that there is further selling pressure. What's now taken a fresh dip is actually the Nifty IT pack. The whole host of mid-cap IT stocks especially has seen significant selling pressure, and even the large cap names are seeing selling pressure. Names like TCS, Tech Mahindra are the ones that are most impacted, and along with that persistent yesterday that saw almost a 10% dip, today is down another 5%. Names like Cyan too are under significant pressure in today's trading session. But as promised, Madana Gopal and Ramu from Sundaram Alternate Assets joins us to discuss market fundamentals and its top sectoral picks. Thank you so much, Mr. Ramu, for joining us. First up, your view on the tariffs. Which are the sectors now you feel post yesterday's sell-off look attractive, and which are the sectors you will avoid post this particular development?
The way we are trying to keep it is very simple. We are trying to focus the stocks that we own and what is the earnings growth in those stocks. The majority of our allocation is in domestic driven, domestic capex and domestic consumption driven. We have very little weights, or we are underweight on both IT and pharma, which is right now being the most talked about sectors at this point of time. So to that extent, does it worry what is happening around us at this point? Not really. We have some exposures, but they are very low compared to the overall. We are underweight in those spaces. We will continue to keep looking at these two spaces. We feel so the base case that we are assuming today is a lot of noise will be there. But what eventually happens in these two sectors might be the end result might be much lower than the fear that is getting created at this point. It's too early to say where we are heading to, but there is certain contradicting factors here to really feel that Mr. Trump's administration will achieve this inflation target, growth target, along with this tariff and trade surplus thing that they're trying to address. It's contradictory in nature, right? So it's not going to, we probably seeing a fear that is getting into the market. The end result might be much different. So we have cash in our portfolios at this point of time, and we are slowly evaluating opportunities in sectors where this fear is creating value zones. We are not in an urgency, but we definitely feel the end result might be very different. And therefore, you have to start looking at these sectors wherever there could be value zones created. But there is no urgency here. I think this fear can give you opportunity to enter into some of these sectors at a really good value.
So the value sectors, which are IT and pharma, and how far are we from getting to the value zone?
Again, I said, I think this noise will take some more time to kind of settle down, because what the negotiation that is being talked about, both on the tariff side as well as on the trade surplus side, while on the tariff side, a country like India has nothing big to lose, in our opinion, from our numbers. But on the trade surplus side, we can still address it if given a certain time period, like probably over the next 2-3 year time period. But imagining the same thing to happen for Europe and Japan and other countries, it looks very difficult. So to really decide on what will happen to the global economy because of all this noise, it's beyond our, I think, beyond our ability to think through. But what we are saying is keep it simple, work on your domestic companies, wherever you have exposures, you can be there, because I don't think domestic economic growth is suffering because of all this to a large extent. And we have large exposures there. We have cash, and we are slowly evaluating IT and pharma from that perspective, particularly IT. We feel that 10 to 15% correction in some of very good growth stocks, we can start getting some entry point. But I think we are not in urgency here. The base case that we are assuming is things will not be dramatically different from what they are right now from a demand perspective in these sectors, while this noise can throw you opportunity to make good entry points.
Understand that. Within IT, would you look at large caps? Would you look at the mid cap names? And in terms of sectors, would you look at IT companies with exposure to the BFSI or to the auto space? Where would your preference lie?
Maybe mid caps. 2-3 ideas we have always played, and because of valuations, we exited these ideas last year. But if we are able to get them at a really good bargain, we don't mind getting into them into these names, because there the growth is pretty good. With large caps, we have worry that the growth can be structurally much lower. It can be in single digit for a long period to come. But with some of these mid cap names, the growth has been pretty interesting, and we have sold them and they were trading at almost like 50 times plus sort of valuation. If you can get them at less than 30 times sort of a valuation, why not? Unless you have a different view on their demand scenario going forward, that's why I said we feel that these are certain sectors where to really think that it will shift to US is a very big call, and I think the end result might be very different.
Okay, and in terms of pharma, what is it that you're doing? Do you like the API names? Do you like the generic names, or is it a complete avoid? Before you answer that, Mr. Ramu, our ticker team just alerts that as you can see at the bottom of your screen, Union Bank has actually gone ahead and given its Q4 quarterly update, and the company has missed both its loan growth as well as deposit guidance by a significant margin. It has missed even the revised guidance that it had given mid-year, and the loan growth at 8.6% versus a guidance of around 13%. A significant miss coming in over there. Mr. Ramu, while you answer the question on pharma, are you also worried about the BFSI space, or do you find value there?
No, I think BFSI, it's a purely domestic story, right? And I don't think there is a big growth. The slowdown in the economy in the first half of this year is now recovering back. And a lot of effort has been taken by the government, both monetary side as well as fiscal side, to support the growth and consumption. So we feel that domestic consumption will come back in FY26, particularly the second half. Therefore, BFSI consumption both looks interesting. Within BFSI, we have always been playing only NBFCs. So in NBFCs, given the regulatory related noise that was there last year, and therefore the valuations were lower, this year we are seeing growth is not slowing down. We saw the Bajaj Finance number yesterday, right? The growth is not slowing down. We are hearing the similar sort of outlook from other companies that we own as well. So growth is not slowing down. The credit cost issue is it's getting resolved slowly and steadily, which got gone into in unsecured loan and MFI loan. That is also getting resolved now. With all this, I don't think we can be very negative. And given the noise that is surrounding the IT and pharma space, which forms almost 20% of the index, if I'm right. So you can't go so negative on the financial space. And within financial space, NBFCs likely to deliver much better growth as well as earnings growth, loan growth as well as earnings growth. So that's a space that I'm not too much worried at this point of time.
Mr. Ramu, any specific views, especially when it comes to some of the old economy stocks? So you did speak about domestic theme, something that you like. So do you like capital goods name, utility names? What are your preferences there?
We are playing one as NBFC, as I highlighted to you, because this is a play on the income growth in the country, per capita income growth. Similarly, we have a similar view based on per capita income growth. Consumer discretionary looks interesting, and with the government taking effort to support the consumption this year with tax cuts, and also there could be some rationalization on GST also we hear, which if it happens, it's again a good boost. So all these are leading to a situation that domestic consumption will be focus area for the government. Government spending also has improved, right? So consumption looks interesting. Consumer discretionary within that looks interesting to us, and we have been always bullish on that space. Within infra space, power sector looks pretty interesting. I think the power sector capacity creation slowed down during COVID. It is not coming back in an urgency. There is capacity constraint globally as well as in India. And this will take a lot of time to get addressed. And Chinese competition is not there after so many years of this sector getting impacted. So power sector equipment manufacturers, we are bullish, and it is reflecting in the numbers of these companies. You see the Q3 earnings growth when the slowdown in the earnings of Nifty is almost like 5% growth, right? So our portfolio delivered almost 20% growth in terms of earnings. So it shows our portfolio is positioned towards growth sectors, and the earnings growth is still continuing. To that extent, again, to repeat, if you are focused on the stocks that you own in the portfolio and their earnings growth, and if it is more domestic driven,
Mr. Rami,
it's not something very easy.
Right, we get that. Thank you so much for joining us and giving us your take on the markets on a day that's once again marked by quite a bit of volatility. Time now for a short break. We'll put the spotlight on the IT sector and the likely impact of Trump's tariffs on the quarterly performance of Indian IT companies. Welcome back to Trading Hour. Well, like we just highlighted, Union Bank, the company put out its quarterly update, and that particular stock and that company has actually gone ahead and missed its guidance, the stock now at the day's lowest point. But the Indian IT sector is the one that we are focusing on. Rima is at the wall to explain the impact of the tariffs.
Thank you very much for that. So I've collated all the brokerages and how they've assessed the potential impact of Trump tariff on the Indian IT sector. Now, Bernstein highlights the near-term risk is a potential recession in the US or global economy that can delay IT spending and result in tightening of the tech budgets. But they've also come out with a worst-case scenario, and that is we could see a deep global recession similar to what happened in 2008 with the financial crisis. And back then, the major IT services saw a significant revenue decline. So, for instance, TCS's revenues were down 6%, Accenture was down 13%, all in Q4 of calendar year 2008. And we're looking at these numbers on a quarter-on-quarter basis. On an average, it was about a 10% sequential decline. Not that Bernstein expects a GFC-like situation once again, but they do expect IT growth to remain flat in FY26, contrary to their earlier expectation of some sort of a recovery post FY25. Now, given the market volatility, their preference is with quality large cap. So Infosys is their top pick. They also like Coforge in the mid-cap space, and the sector that they're underweight, that's the auto ER&D companies. So names like LTTS and Tata Elxsi. Now moving on to JP Morgan, and they're asking the critical question that everyone wants to know. When will the sector bottom out? Now they've identified a bear case scenario, which is no growth for companies like Infosys, TCS, HCLTech in FY26, and also no margin expansion. That, according to their mind, if this plays out, bear case, we're looking at a 9 to 11% EPS cut in FY25, leading to a potential downside of 7% for TCS, 6% for Infosys, and up to 14% for HCLTech. Mid-caps could see an even steeper impact. So according to their bear case analysis, 13% stock price decline for Coforge, going up to 25% for Persistent. So the question is that when is the right time to buy? Well, they believe not before earnings, because a conservative guidance could push the stock prices lower, making a post-earnings entry point perhaps a better entry point. Let the stock prices fall post-earnings. JP Morgan does suggest a lighter IT positioning, but they remain overweight on Infosys and mid-cap growth company. Kotak is worried that this uncertainty at the start of the year will delay spending, and it will affect the June quarter, which is your seasonally strong quarter. They once again cut the revenue and EPS estimates for IT companies after cutting it as recently as March of 2025, baking in the US tariffs. And they're saying that FY26 could even be worse than FY25. And their growth estimates are up for you on your screen. What Kotak Institutional Equity expects in terms of growth rates, expected to be slightly lower than FY25. Given the higher scrutiny on guidance, they say it may be even prudent on the part of companies to defer the guidance until there is more certainty on the demand environment, or restrict the guidance to next quarter where there is a higher degree of visibility. A recession, to their mind, means that more downside risk exists in stocks, while a slowdown will lead to reasonable upsides. And finally, Macquarie, on the other hand, they see the market reaction is overdone. Investors with a long-term outlook should use the opportunity to add to positions in Indian IT. So that's the picture and the way Indian IT has moved over the last 2 days and what brokerages are saying. Sandeep Agarwal, fund manager at Sovilo Investment Managers, is now with us on the show. Sandeep, your first thoughts on 4% downside in IT stocks, 2% now. What is it that you anticipate?
No, so Rima, you have very nicely, said most of it, but let me say this, that, we should see the Indian IT space in three directions now. First of all, if it was tariff, then you can pass on some cost pressures to the client and you can find out a way. But here, it is not about tariffs. It is about global growth coming down. And you know that global growth coming down for a sector which has 80-90% exposure to exports is a very, very scary thing. And secondly, the domestic exposure, whatever they have, they don't make much money in that. So, there is a double challenge. There is a growth challenge and there is a margin challenge. So both the challenges are there. Additionally, remember that till now, neither tariffs have been announced nor any cost of doing business increase has been announced. So since November, when, presidential elections were happening, that time we have been saying consistently that, the cost of doing business can definitely go up. Although you can't execute this services project in US for sure, but there could be more cost implications. So that is still not there. Tariff is still not there. And right now we are only dealing with the uncertainty related to growth. So I think, there could be multiple legs of disappointment. One, growth, second, margin pressure, and third, uncertainty. So I believe that, there is still downside here. And I will not call this bottom. In my view, probably once guidance starts coming in, which I believe that, the companies must give some guidance, even if it is 0%, because then at least it will remove the third risk, that is the uncertainty risk, at least from the picture. Problem is that if they don't issue a guidance, then the uncertainty risk still persists. So my view is that the EPS can actually decline after a long period of time in FY26, and that is what I'm fearing.
But Sandeep, the last time we had this kind of an uncertainty and growth scare was in 2008 and then COVID. Are we in a similar situation for Indian IT right now?
So, in COVID, what happened, it was very short-lived and immediately people realized that, you have to do work from home. So right now, the situation is totally different. In COVID, it was a pandemic kind of situation where you're not able to go and work, but you can do remote work. Right now, the problem is whether there is a demand. And Rima, very well that, one or two large contract getting postponed or cancelled or in abeyance, any such announcement will bring down the multiples of the sector in a very significant way. We have seen that in past with RBS and other contracts. So my worry is that any large contract cancellation, non-issuance of guidance, decline in quarterly number, any of this stuff will bring down the multiples substantially because the multiples are very, very high still, given the growth prospect. The PEG ratios for large caps are like 4-5 times. The PEG ratio for mid caps are like 8-9 times. That is very, very high. So we definitely need to be very careful because the growth will come down substantially if uncertainty doesn't go, and the multiples have not come down to that extent.
Okay. So what is the growth estimate for FY26, say for large cap IT names on an average? And how much higher are the PE multiples? My point is, what should be the growth rate for FY26 to your mind? And what are the appropriate PE multiples you should ascribe for that kind of a growth rate? And how much higher are we currently? What's the extent of derating?
So I think, for the large cap, expecting beyond 4-5% growth for any of the large cap will be very, very risky. I think that is the max. So you should expect from -2% to 5% for large caps. I think that is a decent range. And for high growing mid caps and small cap, maybe, up to 10-12%. Now, given that the multiples are where they are expensive. In my view, if my growth will be below 5%, I should not go beyond 16 to 18 multiple. That also because this is a cash-rich sector, there is a dividend support and all those things. And if the growth is like 10-12%, why should I go beyond 25-28 times 1 year forward? And I think right now the multiples are nowhere close to that. So I believe that, there is a risk to this numbers and multiple level of risk. Remember this, what we are talking about is only growth. Now, if, cost of doing business goes up and margin can definitely take a hit because remember in IT, the nature of the business is such that 70-80% revenue is given, means it is always there because you are servicing contracts for long term. But 20% of the business has to be new, and additionally for 5% growth, you need 5% new business. So 25-30% business in this environment, new in such uncertain environment profitably is a really tough task, and you can't, postpone your wage hikes for a long period of time. And even if you postpone wage hike, there are other costs which are like rent and other things which can't be postponed. Airlines, hotels, you are seeing the travel costs are going up substantially. So margins will also be under pressure. So there is double whammy on that.
Okay, so large cap IT companies to see a max growth of 4 to 5%, and therefore the PE multiple they should be trading at fair value should be 16, 18 times. And currently, most of the IT companies are above 20, going up to about 23, 24 times for TCS. And even for high-growing mid-cap companies, PE multiple should not be more than 25 times. So Sandeep, the entire IT space is in a void, or are there any stocks that you like? What are you advising your clients? And especially if they have, positioning in tech stocks already, should they be looking to sell right now?
So, a major damage has happened in last 5-6 months. We are in probably the last leg of damage where, another 10-15% correction can happen, and we can't say it for all the stocks. So in my view, if someone has positioning, better to stay for long term. If someone wants to enter, maybe, around the results when all the worst is built in, then you can start nibbling and build positions. We still prefer, ER&D, but as you rightly mentioned, ER&D stocks are still very, very expensive. I am not at all comfortable to pay more than 25 times for even ER&D stocks, although they will grow at double the rate of the IT services stocks. So for long term, they will make a lot of money. But I think, there is uncertainty. The problem is not growth. Once, companies say that, okay, we are going to grow at this rate, then you can do the modeling. Right now, there is uncertainty on growth, there is uncertainty on margin, and there is uncertainty on cost of doing business. So 3 uncertainties, how to assign multiple and all this. So it is a really challenging scenario right now.
We'll keep coming to you to get advice for our viewers on what they should be doing right now. But thank you, Sandeep. This was an enlightening conversation. And big cuts. Coforge down 6%, Persistent down 5.5%, Hexaware another 5% gone, Birla Soft literally no place to hide today in IT. Get into a break. On the other side, we'll invite the management of Naukri.com to discuss the hiring trends seen in the month of March.
Welcome back to Trading Hour. Well, the sell-off has intensified. The small cap index now down 2.8%. But one particular stock, especially that's seen a bit of a sell-off in the last 2 trading sessions, is InfoEdge or Naukri. Remember, Naukri.com recently released their JobsPeak index for the month of March. The Indian job market saw a slight decline in hiring on a year-on-year basis. The index also highlights that a 4% decline was seen in overall fresher hiring. To discuss more on this, we are joined by Pawan Goel, Chief Business Officer at Naukri.com. Thank you so much, Pawan, for joining us. First up, give us a sense of how the month, panned by, and also how the quarter panned by, especially in terms of hiring trends.
Yeah, so from let me take the month first. This is the March JobsPeak. Now, this month JobsPeak index is flattish, so I think down -1, but it's colored a lot because Holi was there in our measurement period this year, but it was not there in our last year. So if you were to adjust for the Holi impact, we don't do that in our index, but if you adjust for it, it would have been normally 6, 7, 8% point up. So fundamentally, the white collar hiring market in March has been better than last year if you were to informally adjust for Holi. Though our index is flat because of the measurement period where Holi was there this year, but not last year. Okay, so that's one thing that I would want to call out. Second thing, if you just adjust for that, IT, which shows flattish, would be up 6, 7 points for, I can't say the exact number, but you can say it's in the single digit growth in IT. Now, other trend that we see in March is, which has been secular, that non-IT hiring has been better than IT hiring, and which has been a trend which is sustained for some time. The second thing we also continue to see is smaller city growths are, though of course from a smaller base, they are still higher compared to the metros. So those are the trends that we continue to see. Now, I want February to March, one thing, there are a couple of sectors where things have changed. So if you look at travel, tourism, hospitality, in February, it was growing phenomenally. But given the Holi season, as well as perhaps the Mahakumbh is behind us, that's gone down from 20 to minus 10%. Defense and government defense segment, that has seen a substantial growth. So that was around flattish last month, but now it is in 20%. The other secular trends, which I think we've talked about earlier, AI, ML, again, continues to grow at a very, very fast clip. It is in the high 20s, high 30s, depending on the specific skills. That continues to be there.
Pawan, on IT, X of the holiday impact, growth would have been approximately?
It's hard to say because, but I would guess somewhere in the 5 to 10% range.
5 to 10%. And what have you picked up in terms of whether this will sustain? Because there is this whole cloud of uncertainty on IT now, on tech budgets, IT spending, given the Trump tariffs. What are you hearing on that front, and whether this IT growth will sustain in the coming months?
So prediction is hard for us to do. But what I can say is we don't see any evidence of that yet on our platform. You're absolutely right about the overhang of the tariffs and its impact on the overall economy and subsequent impact on IT jobs. So in the short term, very, very hard for us to predict. But if you look in past, in the past downturns, there's a downward trend followed by a substantial upward swing for IT in India, if you look at the last two downturns.
This number about fresher hiring seeing a 4% decline in the month of March, is that a trend which has been there in the past and is just persisting, or is it something new? And how worrying is it?
So fresher hiring has been subdued for a fairly long time. Now there is fresher hiring. There is growths of there are pockets of growth, specifically in non-IT. There is sectors which are hiring freshers, but overall, in a secular way, there is more and more demand for experienced people. So if you take 16 plus years experience, there it's the growth is in double digits. As you start coming down, the growth starts coming down, and as you come to fresher, it comes to decline. And this trend has persisted for several quarters now, and this is certainly challenging for graduates entering the workforce.
So this weak hiring numbers for freshers, is it restricted to the tech sector, or is it widespread and more broad-based?
It is more in the IT space. There are pockets of growth in non-IT. I wouldn't say it's secular even in non-IT, but there are certain sectors. If I were to bring in, so for example, architecture, KPO research, facility management, media and entertainment, these are all seeing double-digit hiring growth for freshers. But in IT, we cannot find those pockets of growth for freshers.
Right. Very quickly, Mr. Pawan, FY26, which is the sector that you expect to outperform the most?
See, from a long-term point of view, what we have seen over the last couple of quarters, the non-IT sectors, we've seen travel, tourism, hospitality doing well. Healthcare, we have continued to see doing well. These are the 2-3 sectors that have continued to do well. But we unfortunately cannot predict what will happen. We only can talk about what we have seen on the platform.
Pawan, thank you very much for joining us. Enjoy these monthly updates from you on the labor market picture in India. But let's move on. Trump's reciprocal tariffs have shaken the global market. Prashant is joining us. He's at the big wall to decipher what the Trump government aims with this shakeup.
Well, thanks very much for that. Now, it's Liberation Day +1, right? I mean, if I can call it that. The day after what US President Trump and many in Washington have called Liberation Day for the US. Of course, on Wall Street, it was, a different kind of a day. Big time losses, 5-6% cuts, worse since COVID markets in 2020. What is the Trump team's positioning now in terms of what the message they're sending out? The message from his team seems to be clear. They're not backing down. So what's the latest? There's no indication yet that Trump or his team are willing to dilute or delay the proposed tariff. Yes, the administration is open to negotiations, but they are not chasing a quick win here. The bar to even getting to the negotiating table, from what we've heard so far, seems to be much higher. The US isn't just looking at tariff parity. the way the calculations, etc., have been made and the numbers have been put very high, it's aiming for a global restructuring of trade with special focus on structural and non-tariff barriers. And of course, even if there is a deal down the line, the new tariff floor will likely remain at 10%. So minimum is 10, and I mean, on top of it, maybe it can be negotiated down. A key document is already in play. So because I mean, you may wonder, what is the roadmap here? How do you go about negotiating these things? The 2025 National Trade Estimate report from the USTR, it's 400 pages long. It's actually available online. You can go and check it out. It breaks down the foreign trade barriers country by country and was prepared by the Trump team itself. This could shape how and when countries get invited to the negotiating table. So what are the next steps here? The USTR is expected to send a detailed report to the US Congress clarifying what exactly was announced in the executive order. We're also watching for guidance from the Council of Economic Affairs on how they've calculated the proxy tariff rates. Remember that it's not reciprocal tariffs. The tariffs are real, but it's not reciprocal. The number for India is 52%, whereas if you add, the 9.5% which we charge the US plus VAT, etc., it's nowhere close to 52. A practical question ahead, which needs to be also watched closely, is this: can the US Customs and Border Protection actually process these new tariffs without causing port delays or disrupting supply chains, etc.? Important to remember for business disruption, and we'll be asking companies over the next couple of weeks as well. So far, the global reaction actually has been measured. There's been outrage. Several countries have expressed disappointment, regret, but mostly have stopped short of announcing retaliatory measures. For now, most governments seem to be keeping the door open for negotiations. But that could change quickly. So one day after Trump's big sort of tariff play, the tone is set. This is about long-term leverage, not short-term wins. That's the message, at least, that I picked up from everything we've heard so far. This is not to say that there won't be negotiations, but it looks like the Trump team is digging their heels in after the sweeping and much harsher tariff announcements that we saw a day earlier, and wants the message out. Come and negotiate, but the bar is going to be quite high. Back to you.
Thank you so much, Prashant, for joining in and explaining to us on what Liberation Day +1 actually means and what exactly to look forward to ahead. But with that, it's all the time we have on this edition of Trading Hour. Stay tuned. Halftime Report is up next.